Welcome to the internal control consideration snapshot version. So again, these snapshots are intended for those who are already reviewing these concepts or perhaps preparing for an exam or maybe would just like to have a digestible bite-sized piece of this particular topic. But if you want to have the very detailed discussion just like in the undergrad lectures, you may want to pay our related videos a visit. But if you're in the review phase or are in the search for a more digestible version, this one might be for you. So, whenever we talk about internal controls, we appreciate the fact that it could be viewed from either the management perspective or the auditor's perspective. And at this point, we should all start with the management perspective, right? After all, management is the one responsible for the design, evaluation, and implementation of internal controls. So let's try to take a look at or recall what is internal controls in an internal control system, who is responsible for it, and why is it necessary for a business to have one. Well, if we look at the definition of internal controls, we'll be reminded that internal controls is a process. That is why later we will pull out from memory what are the components of internal controls. Just hang on for that. Now, who is in charge for internal controls? We have said management is the one in charge for the design, implementation, and evaluation of internal controls. But other than management, those charged with governance or TCWG are also expected to effect internal controls. And not just that, but even other personnel. Because if you think about it, internal controls would cover the entire entity, and in terms of the implementation, it's impossible for just management and TCWG to do the implementation, right? They do need the other personnel and everyone else in the entity. Now, why does the company need to have internal controls? Well, the answer to that is internal controls provide reasonable assurance on the entity's objectives. And so therefore, we need to review what are the entity's objectives? What are the objectives of our client? And here we point out that the objectives of our client are actually threefold. There are three objectives. Number one, pertaining to efficiency and effectiveness of operations. Number two, compliance with laws and regulations. And number three, the reliability of financial reporting. And at this point, you must feel some sense of deja vu because these three objectives are also the subject of the three types of audits that we have previously discussed. Remember? Operational audit, compliance audit, and FS or external FS audit. Nonetheless, these are the three objectives of management. So internal controls are designed in order to help management secure and protect these three objectives. One very important phrase that we also have to point out is the phrase reasonable assurance. And we know every time we hear this phrase, it simply means that internal controls are not perfect. They cannot give absolute assurance. They cannot guarantee that it will be able to protect the objectives of management. And whenever we say it cannot give absolute assurance, we know that it is because of inherent limitations. And here are the inherent limitations of any internal control system. I personally would like to use the mnemonic shocker because I feel like it's such a shock. Like designing internal controls, implementing them, and evaluating them comes at a cost. So why can it not provide absolute assurance? Well, here are just some of the inherent limitations. Number one, internal control systems are systems, and any system is always vulnerable to a system breakdown. Number two, there will always be the presence of human error. Even the most digitized, the most highly technological version of internal control systems will always have some human factor to it. The design in itself is already a product of a human judgment. And every time there are human beings, because we are not perfect, there will always be human errors. Third is the possibility of management override. That being said, management, because of their authority and their position, can actually put the internal controls in pause. Management has the power to stop or to put in pause internal controls. And when they are put at a pause, then this opens the floodgates to possible misstatements to come in the entity. So there will always be the possibility of management override. Another is the possibility of collusion. If you would remember the concept of segregation of duties, we segregate the duties to ensure that no one person can commit fraud and get away with it undetected. However, can you imagine what will happen if they will all collude or agree amongst themselves to perpetrate the fraud. That being said, even the best internal controls would be at the mercy of collusion. So that is another inherent limitation. Again, another inherent limitation is, of course, internal controls would have to look at cost benefit. At the end of the day, internal controls are intended to protect the objectives of the entity. And so, therefore, common sense would tell us management cannot just utilize all of its funds or resources to come up with the best internal controls, but then would eventually might lead them to bankruptcy, right? So there always has to be that balance between cost and benefit. That is why companies could only have optimal internal controls, not really the maximum or the best internal controls, because there are limitations relating to cost benefit. And lastly, internal controls are directed towards routine transactions. That being said, should there be non-routine or non-normal, unusual transactions that the entity would encounter, internal controls would be rendered not really useless, but then less effective against these non-routine transactions. So all of these would lead to the inherent limitations of internal controls. We also highlight the fact that internal controls is a process. And like what we said, being a process, we do have to recall that there are components of internal controls. And these components are five. First, we have what is called the control environment. And we know that the control environment is very important. This is what we call as the tone at the top. This sets the culture of the entity. And being the tone at the top, this is the tone of TCWG and the tone of management. We all know that the people running the business, managing the business, being in the oversight function of the business, has the power to shape the culture of the entity. Therefore, whether your client is committed to quality or not, whether your client has a sense of discipline or not, whether your client values certain values or not, that will all be a product of the control environment. So, control environment, tone at the top. This sets, molds the culture of the entity. Secondly is risk assessment. Now, we know we have talked about risk assessment exhaustively in audit, but remember here, we're looking at this from management perspective. And to management perspective, risk assessment will refer to the identification and the assessment and eventually the management of what we know of as business risks. Now, business risk is a much more broader concept than the risk of material misstatement, because when we talk about business risks, these are risks that attack the objectives of the entity, ergo the objectives of the client. So anything that attacks operations, anything that attacks compliance, anything that attacks reliability of financial reporting, that will fall under the ambit of business risks. And management must have a risk assessment process in place. A third component is what we know of as the information and communication system. And it is in the information system that we get to see, or that we get to see the accounting information system itself. So the AIS is part of the entity's information system. Communication systems would, of course, involve both the inflow and outflow of communications, both inbound and outbound communications as well. And then we have control activities, and control activities are the specific steps or measures in order for management to meet their objectives. Control activities are categorized into four, and we call them PIPs, PIPS. The first P, of course, being performance reviews, where we will get, for example, your key performance or the company's key performance indicators, the presence of quotas, variance analysis, and the like. These are performance measures. Letter I is for information processing, not to be confused with the information system, which is a broader concept. This one is information processing. Meaning to say, if you think about IPO, input, process, output, the controls related to IPO will go here. Are the source documents pre-numbered? What is the process of authorization? Do they do batch processing, real-time processing? All of these things are under information processing. Now, the other P is what we know as physical controls. You think about locks in warehouses. Yeah, you think about padlocks, physical controls, that which would restrict the movement or even the entry or custody of assets. So that's another control activity. And lastly, of course, one of our most favorite control activities of all time, segregation of duties, where we segregate the duties of care. Care would stand, of course, letter C for custody, letter A for authorization, letter R for record keeping, and letter E for execution. So those are control activities. And lastly, to complete the components of internal control, we have monitoring. And we remember that monitoring actually monitors the other components of internal controls. And we have two types of monitoring. These are either ongoing monitoring or separate monitoring. Now, whenever we talk about separate monitoring, it is monitoring that is anchored on a certain time frame. Like say, for example, if you talk about annual audits or monthly reviews or quarterly checks. So whenever it's associated with a time frame, then it is separate. Otherwise, it will be ongoing monitoring. So these are the components of internal controls, all viewed from the context of management. Because we are talking about auditing theory, we now have to look at internal controls, this time from the shoes of the auditor. So in the case of the auditor, we recall that PSA 315 or ISA 315 actually requires us to, number one, obtain an understanding of internal controls, and number two, we are required to document that understanding. To obtain the understanding of internal controls, we actually perform risk assessment procedures, which are represented by our big three IIO: inquire, inspect, observe, and to look at the implementation part, included to that will also be our walkthrough tests. In terms of documenting our understanding, we also recall that the standards do not prescribe a specific type of documentation. That being said, you can utilize flowcharts, internal control checklists, internal control questionnaires, narratives, or even decision trees. So the standards do not require a specific form of documentation. However, the standards do require us to document our understanding. Now, when we pull out the audit risk model, which is one of our most favorite models of all time, the consideration of internal controls will of course happen in our assessment of control risk. Now, it is at this point that we also get to recall that our control risk assessment is done in both RAP and test of controls. RAP, of course, to represent risk assessment procedures, and like what we said, our big three, IIO plus walkthrough, if you're talking about control risk assessment. Test of controls, on the other hand, will be comprised of still the big three, IIO, inquire, inspect, observe, but then this time with the addition of re-performance. So re-performance means to re-perform a control. Now, please do take note at this point, whenever you talk about a a walkthrough test can only reveal implementation of the controls, not the operating effectiveness. With that, we'll be able to appreciate that when the auditor performs risk assessment procedures, the auditor looks at the design and implementation of the controls. But when the auditor performs tests of controls, the auditor looks at the operating effectiveness of the controls. Implementation and operating effectiveness are two different things. When you talk about implementation, it answers the question if it is implemented at a specific point in time. So when you perform a walkthrough, when you walk it through the initiation down to the final recording, was it initiated at that point in time? But if you talk about operating effectiveness, it refers to a period of time. So again, walkthrough will only reveal implementation. Okay, so RAP would look at design and implementation. Test of controls will look at operating effectiveness. We also know that risk assessment procedures are required. There's just no way for us to get away with RAP. We do have to perform RAP. It is required. But in terms of tests of controls, you may know this one already. Tests of controls are not required. Tests of controls will only be performed in two instances. Number one, if there is an intention to rely on the controls. And number two, in the case of RSPAs, or those which you know to be risks for which substantive procedures alone, that's RSPAs, risks for which substantive procedures alone cannot provide sufficient and appropriate evidence. In all instances, when the auditor decides to perform tests of controls, the auditor must first determine the cost effectiveness of testing the controls. Meaning to say, when I test the controls, is it likely for me to be able to reduce later my substantive testing should I find out that the controls are effective? Okay, so again, there's still that cost benefit consideration in the performance of test of controls. Now, because we are talking about control risk assessment, we also get to recall that in the case of risk assessment procedures or our RAP may be the source of our preliminary or initial assessment, our first assessment of control risk, and even our final assessment. It becomes the source of our final assessment if our initial assessment is that it is also at the maximum. I'll explain in a few. Okay, the test of controls, on the other hand, will become the basis for the final assessment if the preliminary assessment is less than high. Now, if in case it's a little bit confusing, let's try to illustrate that with this. So, assume, for example, that we are in the risk assessment phase, and in the risk assessment, we might see, based on the design and implementation, that control risk may be high or low. So if based on the design and implementation, we have determined control risk to be high, that means we don't intend to rely on the controls, right? That means the design and implementation are already weak. But we can also see that the design and implementation may be okay. It might be inviting us to want to rely on it. It seems strong, and so therefore our preliminary assessment may be low. Okay, so assuming that our preliminary assessment is high, meaning there is no intention to rely, and if there is no intention to rely, then we will perform intensive substantive testing. We will magnify our substantive testing. So in this case, notice that your preliminary assessment, which is high, will also become your final assessment. There is no way for you to change your mind. Why? Because you do not perform tests of controls. The only way that you can change your mind is if you perform tests of controls. So if you did not perform TOC, your preliminary also becomes your final assessment. Okay? However, if upon inspection of the design and implementation, the auditor sees that it's promising, the design and implementation is promising, and so therefore I wish to rely on the controls. There's an intention to rely. If there is an intention to rely, then the auditor will perform tests of controls, assuming it's cost beneficial to do such. And in the performance of the test of controls, looking at operating effectiveness, the auditor may discover that the final assessment is high, meaning to say, I thought the design was okay. I thought it was implemented well, but when I tested the controls, apparently it was only good on paper. Okay, but it's not operating effectively. And so therefore, the auditor will say, well, my bad. I thought it was low, but apparently it is high. And in that case, the auditor will then perform intensive substantive testing. However, it is also possible that the design and implementation makes you believe it is good or strong, and when you tested it, you were proven right. It was indeed effective. It was indeed operating effectively. And so in this instance, your initial assessment, which is low, was proven right by the test of controls. And so therefore, the auditor will say, yep, the internal controls are indeed operating effectively. And so the auditor will now perform less intensive substantive testing. So this is the relationship between the preliminary assessment and the final assessment of internal controls. Having said that, let us also recall what are the documentation requirements for internal controls. Remember, we are required to obtain an understanding, and we are also required to document the understanding. So then what must be documented? So let's take a look at it from both assessments. Number one, if control risk is assessed at less than maximum, and number two, if control risk is at the maximum. So just as a reminder, when we say control risk is less than maximum, that means there was an intention to rely on the controls, and the controls upon TOC was proven to be effective. Okay, if control risk is at the maximum, that means no intention to rely, design and implementation are already nah. So if it's not already promising, there are already deficiencies in the design and implementation. So are we required to document the understanding? The answer to that is obviously yes, right? Our standards always require us to document the understanding regardless of the control risk assessment. Secondly, are we required to document the assessment? The answer, of course, is still yes. Okay, whether you assess it as high or low, you have to document it. You have to let whoever will review your working papers know what was the assessment that you made. But as the third item, are you required to document the basis for the assessment? The answer is if the control risk is less than maximum, meaning to say you have concluded that the controls are reliable, then yes, you have to document the basis. And the basis for that will be your test of controls. That is what will prove, in effect, that the intention to rely is warranted. However, if your assessment is at the maximum, no intention to rely on the controls, there is no need for you to document the basis for the said assessment. Because in the first place, if you had no intention to rely on the controls, then you did not perform tests of controls. So there's no basis for assessment to document in the first place. So that's the summary of the documentation requirements. And finally, we talk about deficiencies in internal controls. At this point, please be reminded that external FS auditors are not required to give an opinion on internal controls. We are, of course, talking about this one from the ISA PSA Philippines setting. If there would be different rules that need to be followed in case, for example, of US audits covered by PCAOB, so that's a different thing. But for the ordinary FS audit not covered by PCAOB or Sarbanes-Oxley, the auditor is not required to give an opinion on internal controls. However, in the process of understanding internal controls, the auditor might be able to see deficiencies in internal controls. And while we do not give an opinion on internal controls, there are certain deficiencies that we must report to management and TCWG. Now, a deficiency may be either a deficiency in the design, meaning to say there are missing controls or missing controls in the case of the design of the controls, or they are not properly designed. But it is also possible that the design is there, but it just wasn't implemented. So in the case of implementation, it is not operated as designed. So we may be able to see either deficiencies in design and or deficiencies in implementation. Now, in the case of deficiencies, we might also encounter control deficiencies. These are, just any type of deficiency that you see, whether design or implementation. If you talk about significant deficiencies and material weaknesses, significant deficiencies and material weaknesses would refer to those types of deficiencies that must be reported in writing. Remember that these have to be reported to both management and TCWG in writing. Okay. Now, at the onset, once the auditor discovers the deficiencies, there may be an initial oral or verbal communication, and that's okay. But then eventually, it will have to be reported in writing. So, what is the difference between a significant deficiency and a material weakness? As I think at this point, you'd already know, significant deficiencies are less severe than material weaknesses. They are still important enough to warrant attention from management and TCWG, but they are not expected to reasonably result in material misstatements. Material weaknesses, on the other hand, are those which are likely failures in internal controls that will likely lead to material misstatements. So in terms of severity, material weakness would be the most severe and then followed by significant deficiencies. Control deficiencies are just these are generic. This is a generic term to refer to all deficiencies. So not all deficiencies need to be communicated, only significant deficiencies and material weaknesses. And again, they have to be reported in writing. So, yep, that's about it. That's our snapshot version for internal controls. I hope you enjoyed that one. So thank you so much, everybody, and see you in the next snapshot.